Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Well, it's been a little over half the year gone now, and it's been a different year, perhaps a difficult year for investors because it's not been a year of straight line equity market returns. So now, as you're assessing your portfolios, what's the prognosis? What's the advice? Not just for the second half of the year, but on a longer term basis. Is this a new normal of sorts that we are in when it comes to markets? Well, today on the show, we are going to get you the Motilal Oswal Private Wealth View. Ashish Shanker is with me on the show to take up a couple of questions that investors really have on their minds. Ashish, thank you so much for joining and welcome to the show.
Yeah, hi Surabhi, always a pleasure to be on your show.
You know, that's where I really want to start because a lot of people got used to very good returns, and returns in quick bursts. But the last couple of minutes, the equity market has been testing our patience. So first of all, you tell us, before we talk markets and portfolios, you tell us what investors are telling you when you talk to them across the length and breadth of the country.
So, I feel it is the much needed temperance that has come in. Because if you look at the last 3 years, it's been outstanding. I mean, till last October, you felt nothing can go wrong with equity markets. Portfolios were doing CAGRs of upwards of 20, and certain mid-cap, small-cap portfolios are doing 25, 30%. If you remember, we were hearing about stocks going up in a vertical fashion on the SME exchange.
Yep.
Now, you don't hear about the SME exchange. So I think this temperance was much required. I mean, as you know, we released a note at the beginning of the year in our publication called Alpha Strategist. And the title this year in January was Opportunity in Adversity.
Yes.
Right? Or Opportunity in Crisis. Because we felt that this year is not going to be as smooth after 2-3 years of spectacular returns. And it's been a very, very testing year, to say the least, so far.
Yeah, I mean, I'm just looking at the returns as well. I mean, at the index level, the Nifty is up barely 3.5–4% for the year as a whole. And even if you're looking at the mid-cap index, and the index level, we haven't seen gains. Individual stocks could have done, of course, much, much better. But Ashish, do you still get the sense of optimism from investors in terms of deployment? I mean, even if you look at flows that are coming to mutual funds, for instance, the SIP flows are intact, but the overall flows are, almost 40% lower from the peak. So what's the sense you get?
So it's a mood of skepticism right now. I mean, if you look at the indices, they don't tell you the full picture, right? Nifty seems to be up 4–5%. The mid cap is also doing fine. But if you look under the hood, right, there have been a lot of shifts. There have been sectoral shifts. There have been stocks which are down 20–30%. There are some stocks which are testing new highs. So the kind of exuberance we saw in September, October is not there today. So people are being a little skeptical about their allocations, especially when it comes to equities. So I think the mood is that of tempered optimism, which means that if you take the medium and longer term, yes, people are continuing to be positive on India, but they're saying, let me make my allocations in a gradual fashion.
Absolutely.
Because the last 6 months, whenever you've made an allocation into equities, you've got hit by something or the other.
That's true. Right? No, absolutely. And that is where, I mean, these are the markets that make you realize the importance of asset allocation and not having all your eggs in one basket, right? And we've seen that. We've seen gold do so well relative to equities over the last 12 months or so. So actually, let's start there. Now, let's come to your mid-year call as it stands. Purely in terms of asset allocation, where were you at the start of the year? And have you changed at all between fixed income, equities, precious metals, or anything else?
Right. So, same time last year, if you recollect, we had given even earlier actually, we had given a clear buy call on gold. Although we've always had gold in all our portfolios as a hedge. But we gave a buy call on gold because we believe that the future looks good and optimistic for gold as an asset class. So, it's done extremely well. Now we are saying that you must have gold in the portfolio. But it's probably not an investment call, right? It's more like a hedge, back to gold being a good old hedge in the portfolio. So about 10–15% gold, I would say. And I'm right now talking about a balanced portfolio, right? Equities, I would say still we are optimistic. But the outlook from a return point of view, you have to temper down. Let's say 12–15% is a good range to expect in equities in India going forward as well. So maybe 50–55% equities. And the rest, you could do it through hybrid funds, debt kind of an allocation, because hybrid funds give you the tax advantage. Obviously, for portfolios which are much bigger, you have things like structured debt where you can enhance the yields on the portfolio. But this is how, I would say you should look at your portfolios. And just to give you an analogy, because we've just had a historic win yesterday, right, over England.
Yes.
Right. So if you actually compare the markets to cricket, this month the title of our report is called middle overs, right? So you have the pinch hitting overs at the beginning, right? And then there is a period where, you know, it's a very boring period, but you should not lose your wicket, right? Those are the periods where you keep adding singles. I think in equity markets, we are at that stage, right? Don't do anything adventurous, don't do anything funny, stick to your asset allocation, you know, do your flexi cap, large cap allocation, and just bide your time in the markets.
So take the singles, maybe the big hits are not coming right now. Take the singles, save your wicket. Correct. It's that kind of time in the equity market. That's so nicely put, very well put. Now, within that, let's dive a little deeper, and actually let's start with gold, because you mentioned that, right? And I remember our conversation many years ago where you took a very clear call saying portfolios can even go up to 15-20% on gold. Now, isn't the gold rally looking tired to you? I mean, what's the sense? And people are now moving to silver, so people think, chalo, gold chal chuka hai, let's buy silver. What do you say to that trend?
So gold and silver are not the same asset class, because silver also works on, you know, economic growth. It's an industrial, it's a part industrial, part precious metal. So I'm not too sure about silver, because globally economic growth outlook has been moderated after whatever has happened over the last few months. Gold, we believe, should continue to be there in portfolios as a hedge. So I would say between 10 to 15%, depending on, you know, what kind of equity allocation you have. Because remember, gold is a hedge to equity allocation, right? So 10 to 15% is where I would put gold at. But between gold and silver, I would still stick to gold. I mean, silver is a little more complicated than gold. Because for silver to do well, you need global growth, you need industrial growth, because silver is a commodity often used, you know, in industrial applications as well.
Okay, all right. So don't sort of extrapolate the wins and the sparkle of gold entirely onto the silver market. Got that. So let's talk equities now. And you're saying, actually saying maybe about 50-55% of the portfolio should be direct, you know, full equity. That sounds fairly low, right? Because historically in India, especially people who have the risk appetite, you know, young or middle, sort of middle-aged, they'd want to have a lot more equity. Is this one of your, you know, lowest historic equity allocations in the model portfolio?
No, not really. I mean, basically, I was giving you color on a balanced portfolio, right?
Sure.
For people who are doing SIPs and building longer-term portfolios, I think you can continue to invest into equities and be a little, be aggressive as well. It's just that, you know, we are saying this is not a time to take a very bold call on equities, right? So, which means overweight is not a stance that I would recommend. I would say that you should be neutral to all asset classes. And like I said, you know, this is a time to bite through markets rather than trying to be very adventurous and trying to create, you know, a lot of alpha in the portfolio. So it's a time to just be careful, that's all.
Fair enough. Now, like I was going back to returns, and the whole question that then next comes for investors is mid cap, large cap, small cap, how to break up that equity allocation. This year, nothing has worked. I mean, the Nifty is up 3.5%. The mid-cap index is flat. The small-cap index for the year as a whole, year to date, is down almost 5%. So it's been tough in that sense. Between the market capitalizations, what's your call, Ashish?
See, it's a classical market for alpha managers, right? Because if you look at Nifty, even in the Nifty, you have stocks which have fallen 30-35%.
Yes.
Right? Take a TCS, which
Tata
is a
Motors,
bellwether
TCS,
stock.
IndusInd Bank.
Right. Who would think TCS will fall 35%, right? And then if you go under the hood, right, below the Nifty, there are stocks which are hitting all-time highs. So what is basically happening is there are shifts happening in the economy. So India is going from, let's say, a low-income country to a middle-income country over the next 3 to 5 years. So consumption patterns are clearly changing, right? A lot of money is going into newer sectors like renewables, manufacturing, and then you have the classic sectors like capital goods and defense coming back because of government capex. Now, unfortunately, a lot of these sectors do not have representation in your main index. So I think this is a period for stock selection. I would say I would be agnostic towards market caps. So a flexi cap fund works well. But in any case, a flexi cap fund will have between 50 to 60% large caps. Within large caps also, right, you have a digital platform which is hitting all-time high. and you have a traditional tech company which is hitting, a 52-week low. So there's that divergence. So I think this is a classical pitch for a alpha manager, right, to pick up the right themes and create alpha in the portfolio.
I have to ask you this, and I know you have the 4 C's framework. I think that's what it's called.
That's right.
Since it's all going to be about the fund manager that you choose to back, right? Give us some names. I mean, there's so much churn in the industry as well. There are the old stars.
Right.
But in terms of, say, the top 2-3 fund managers that you have your eye on for the next several quarters.
Yeah, so we have more recommendations in the flexi cap category, as you would have guessed from my view. So there are 4 managers that we've put out there. One is somebody who has a small fund but very, very experienced in markets. Both of us know him well, Samir Arora, the Helios flexi cap fund, excellent stock picker. Then, Naren, again, the ICICI Pru Opportunities portfolio, slightly contrarian bent of mind, but, creates alpha through sector rotation. Then we have the Motilal Oswal large and mid cap fund, which is a high quality, high growth kind of a fund, and the Nippon flexi cap fund, again, a very experienced manager. I think between these 4 funds, you will get a reasonable diversification in terms of style, and all 4 have demonstrated track record in creating alpha. If I go to the mid and small cap names, maybe an Edelweiss mid cap fund has done extremely well. A Motilal Oswal mid cap.
Just hold that thought, because what I want to do is dive a little deeper into these funds and some of the fund managers as well. So we'll take a break and come back with exactly that, some of the key fund recommendations and why Ashish likes both the funds as well as the fund managers. Back with that in just a bit.
Let's talk money